Welcome to the Introduction to the Credit and Traditional Loans lesson for the financing course. This lesson is with Sarah and Jan. We would like to invite you to take a minute to print out the workbook section for this lesson and get a pen or pencil to take notes. Because your credit score is important when you're qualifying for a traditional loan, this lesson discusses how to improve your credit. This lesson also introduces how credit is calculated and weighted by a lender when they are qualifying you for a loan. This lesson also gives you information about traditional loans, which are an important financial decision in the lives of most people. Even though most people don't understand the various terms, fees, and concepts associated with loans. We will discuss the different types of loans available, as well as the government loan programs for investors. We also discuss the laws involved with lending and what to watch for when shopping for a loan, as well as the paperwork required to apply for a conventional loan. Before you start this lesson, make sure that you know the following: the basic principles and terminology used in real estate investing, which properties to look for and why, where you want to buy real estate, how to locate motivated sellers, and the basics of financing. After you diligently apply the principles and concepts in this lesson, you should come away from this lesson being able to do the following: understand your FICO score and what affects it, explain what improves a credit score, know the relationship between credit and mortgages, explain the terms related to loan shopping, explain how a lender secures a loan, understand disclosures and lender laws, explain what can vary in a loan, list the types of loans, list the types of loan programs, summarize the refinancing process, understand general loan application paperwork, and finally, explain the general conventional loan qualifications ratio.
Many first-time homebuyers find they get more than they bargained for when applying for a loan. Completing the paperwork and trying to improve their credit score can be a tremendous effort. Going into a loan application blind can be detrimental to qualifying for a loan. All of the following factors ultimately determine if your loan application is approved or denied. Just because you make a good income doesn't erase other negative marks on your credit report. So here are some tips as to what lenders are looking for on a loan application. Tip number 1, adequacy. Mortgage lenders want to make certain that you can make loan payments each month. Your income will largely affect this part of the process. Lenders also want to be sure that you can pay all of your property taxes and homeowners insurance policies. Tip number 2, track record. Mortgage lenders obviously want to know how you paid your debts in the past. This is where your credit score and credit history report come into play. By working to improve your credit prior to applying for your mortgage, you may stand a better chance of demonstrating a successful track record. Tip number 3, collateral. Your prospective new home will require an appraisal that will assess the value of the home relative to the agreed-upon purchase price. Tip number 4, equity. The mortgage lender will consider the amount you put down on the home. Based on the purchase price of your home, the higher your down payment, the more favorable your loan application will appear.
If you recall in the financing lesson of the Real Estate Basics course, we introduced and explained what a Fair Isaac Credit Organization, or FICO, credit score was. FICO is the pioneer in consumer credit scoring, and even though there are other proprietary credit scoring systems, it is the standard banks, businesses, and employers use to evaluate borrowers, consumers, and employees. Your credit score is a number between 300 and 850 and is obtained from the major U.S. credit reporting agencies, Equifax, Experian, and TransUnion. A 3-in-1 or tri-merge report will pull your score from all three of these agencies. If you have had 60 and 90-day late payments on your credit report, your score drops. Foreclosures, bankruptcies, and collections negatively affect your score as well. This table breaks down the credit score ranges. Please take a moment to view the table before proceeding to the next slide.
So, how is your FICO score and mortgage affected by the Credit Bureau report? Your mortgage terms are incredibly dependent on your FICO score. If you want to get a conventional loan, you want to have the highest credit score possible so you can get the lowest interest rate and qualify for the most loan options. A score over 700 will get you very nice rates. A score below 620 is considered subprime, and you will not get a good loan because you are perceived to be higher risk.
Shown on the screen is a chart detailing the odds lenders consider regarding your credit score and how it relates to your chance of becoming delinquent. While scores are important, they are not the only criteria lenders consider when approving a mortgage. Other offsetting factors can balance a low credit score, such as a large down payment, large cash reserves, or an overall low debt-to-income ratio. Don't assume that you can't get a mortgage because of a low credit score, or limit your loan search to lenders that specialize in loans to people with troubled credit. Instead, look for a lender who does not charge a fee to take your application and qualify you for a loan. As we mentioned earlier, late payments, foreclosures, and bankruptcies all affect your credit score. Here then are the factors that are used to calculate your credit score. Recent payment history over the last 12 months. This has the greatest weight because 35% of your FICO score is based on your payment history. Reoccurring late payments affect your FICO negatively. Credit cards, rent, mortgage, or car loan payments, their number and amount can also affect your score. Bankruptcies, foreclosures, tax liens, and judgments all negatively affect your score. Having a foreclosure or bankruptcy on your record may lower your FICO score by as much as 100 points. Credit balance. This refers to your debt-to-credit balance. That is, how much debt you have compared to your available credit. In other words, owning maxed-out credit cards is bad. Actually, having many credit cards with just a little debt is good and is much better than having 2 or 3 cards close to the limit. Pay off credit card debt and stay below half the limit of each card to improve your score. Amount of debt. Your debt will count towards 30% of your FICO score. Oddly, it turns out that closing old accounts negatively affect your score, while, as we said with the last item, having many accounts with a small balance keeps your score up. However, there is a cap on the number of accounts you can have before your score begins to be negatively affected. Credit history length. The longer your credit history, the higher your score. Your credit history length counts as much as 15% towards your FICO score. Lenders appreciate people with significant credit history. New credit and loan applications. Another 10% of your score will go to your loan applications. If multiple lender requests show you have been looking for more credit, possibly more than you could carry, your FICO score may be hurt. Types of credit. The types of credit you use account for another 10% of your FICO score. If you show you can handle both secured and unsecured debt, your FICO will be positively affected. That is, you need to pay a mortgage and not rent to maximize your credit score, as well as carry and pay small balances on your credit cards. Too many simultaneously pulled soft credit scores made by you or your employer and lenders with or without your consent can reduce your score, as they signify to creditors that you are shopping for too much new credit. Too many credit cards or newly opened accounts also affect negatively your credit score calculation. Employment history and marital status. The more stable you are, the higher your score. Your age. The older you are, the higher your score. Your current address. Your score can be affected by where you live. And finally, if you are on a social benefit program or receiving government benefits because of poverty, this can negatively affect your score as well. If you have a bad credit score, you need to improve it as soon as possible. The truth is, increasing your credit score takes time and effort, and there are no quick fixes. First, you need to keep your debt low. If you have credit card debt that you can afford to repay, pay it. Also, if a credit card balance is approaching the limit, either increase the limit or transfer part of the balance to another credit card, as exhausting a credit card limit negatively affects your score. Another task you need to do is to bring your late payments up to date. Late payments hurt your score severely. If you have a credit score of 600, You mainly need to clear up 90 and 60-day late payments. Since credit history does matter, taking on another loan you can afford while trying to increase your credit score makes sense. This will help your score in a very short time. Once your credit is back to normal, or close to normal, you can refinance out of the loan and take a conventional loan instead. You also need to restrict the number of credit inquiries for new credit. The more inquiries you have in a given period of time, the more hits there are on your credit. You also need to reduce the amount of credit you have used on any one credit line to less than half of that line of credit. Financial advisors usually recommend paying off the credit lines that have the highest interest rates first, and we recommend that approach if you also use the interest savings to pay down your closest to the limit debts. To really improve your credit rating, look over your credit report and note any problems or inaccurate information, and rectify them with the credit bureau in question. Since not every company reports to Equifax, Experian, and TransUnion at the same time, your scores will differ, as will your records. Closing a revolving line account will never improve a FICO score, and in some cases can harm it, although some advisors say that closing installment loans can help improve your credit score. This is because closing one or two of these credit accounts without reducing your overall borrowing boosts your ratio of indebtedness compared to the total amount of credit available. Lenders prefer to see that you have lots of credit available, but that you use relatively little of it.
Let's switch gears now and talk about home loans and the process to get them. This module discusses how your local lender or bank determines your home loan rate. With all loans, the risk of the loan determines the final rate. Every time someone adds a higher element of risk to their loan, like putting down less than 20% or not having at least a 700 credit score, lenders charge higher rates, just like health insurance companies charge higher premiums for clients in poor health. There are really two pieces to mortgage rates. First, there is a general market price for loans. This is how Wall Street and the open market prices mortgage-backed bonds. Second, your local lender/mortgage broker takes the Wall Street or open market rates and then offers them to the public. Let's assume that today's market price for a loan is 6.5%.
Now, here are some specifics to getting a good mortgage rate. In order to get this 6.5% loan, you must meet these qualifications. Put 20% down. Have a credit score of at least 700. Purchase a property that will be owner-occupied, or if the property is a condominium, purchase one in a complex that is at least 50% owner-occupied. Have 3 months savings in an account, or have 3 months worth of payments in the bank. Document all income with tax returns and/or a W-2. Have a debt-to-income ratio, or DTI, not to exceed 45%. And set up an escrow account so the bank, and not you, pays the taxes and insurance. If you meet all these guidelines, then you would likely qualify for the best available rate. In this scenario, 6.5% for a 30-year fixed loan. If you wanted a 15-year mortgage, the rate would be lower because 15-year rates are lower than 30-year rates.
Let's talk now about the different loans that lenders offer. If you recall, in the financing lesson of the Real Estate Basics course, we introduced all the different lending institutions as well as people who could help you get a conventional loan. So if you do not recall these options, you should review this lesson again. Further, for more details on the advantages and disadvantages of each loan type presented here, please review the guide that accompanies this lesson.
Fixed-rate mortgages, or FRMs, are the most common and the simplest loan type. An FRM maintains the same interest rate throughout the life of the loan and is great for those who anticipate keeping their houses for the foreseeable future, prefer to avoid risk, and don't expect any major increase in income. FRMs are the first choice of many risk-averse borrowers. If they can afford to, borrowers can make additional principal payments to accrue equity faster so that they can retire the loan sooner and thus pay less interest.
An adjustable rate mortgage, or ARM, has an interest rate that changes based on current market rates and economic trends. ARMs usually offer an initial interest rate that is 2 to 3 percentage points lower than fixed-rate mortgages, but ARMs don't offer the stability of a known mortgage payment. If you don't expect to be in your home for very long, an ARM may be just what you need. How often your interest rate adjusts is determined by the terms of the loan.
A hybrid ARM is simply a combination of an ARM and an FRM. This popular loan choice features an introductory period in which the rate is fixed. Generally, the shorter the fixed rate period selected, the lower the rate. Most loans offer introductory fixed rates for the first 3, 5, 7, or 10 years of the loan. At the end of the introductory period, the new rate is calculated the same as a regular ARM, using a published financial index plus a margin agreed to by the lender and borrower. This is called the fully indexed rate. Like regular ARMs, hybrid ARMs come with adjustment rate caps and lifetime rate caps. The difference is that there may be an additional cap, the first adjustment cap.
An option ARM is an ARM with a twist. It offers the lower interest rate of a standard ARM while allowing borrowers to choose how much they want to pay each month, from minimum payments as low as 1% to interest-only payments, fully amortized 30-year payments, or accelerated 15-year payments. Borrowers can tailor their payments to accommodate economic necessities and lifestyle choices. The option ARM allows the borrower to use equity in the home to keep the payments low. If rates drop or the borrower's income increases, they can accelerate the payoff with a 15-year amortized payment. Those expecting a windfall, like an inheritance or legal settlement, can choose to pay down the balance. Some lenders will even recalculate or recast the loan based on the new balance.
Hybrid option ARMs combine the features of traditional option ARMs with hybrid ARMs, offering fixed rates and payments for short or medium terms like a hybrid ARM, giving the borrower more predictability and safety while retaining the flexibility of a traditional option ARM. These loans generally feature slightly higher minimum interest rates and minimum payments, leaving less chance for insurmountable negative amortization. Their fixed rates are built-in safety nets for borrowers, making them a safer alternative to traditional option ARMs.
Graduated payment mortgages, or GPMs, are mortgages on which the payment starts low and rises over time. Since the initial payment is used to qualify the borrower, the GPM may allow a borrower to qualify who would not qualify with an FRM. It is also known as a stepped rate loan or negative amortization loans. They offer adjusted payments at predetermined intervals. It is not an adjustable rate, it is a fixed rate of interest.
Biweekly loans are paid every 2 weeks and are used as a tactic to reduce the time that the loan has to mature because the principal is being paid down a lot faster than with the normal once-a-month payment schedule.
Generally speaking, a subprime mortgage is given to borrowers who are not considered prime or who don't possess good credit. Subprime loans generally have rates that are higher or, if they are adjustable, adjust more often than prime adjustable loans. Subprime loans also can be interest-only, which we explain next.
One of the more popular new mortgage products on the market is the interest-only mortgage loan. With these loans, only the interest is paid for the first few years. After that, the mortgage loan becomes fully amortized, which means you pay a monthly principal payment as well as the interest payment. Some borrowers use interest-only loans because their initial payment is lower, allowing them to buy a more expensive property.
No income documentation, often called no-doc, loans require no employment, income, or assets to be stated on the borrower's loan application. Lenders do not verify any information beyond the borrower's credit profile and the value of the property. These loans are useful for people who are self-employed or who have an employment history that is too short to document.
Bridge loans are designed to get you through a temporary mortgage transition period. Depending on your local real estate market, it often is advantageous to buy a home before selling the one you live in. In a competitive real estate market, you would use a bridge loan to buy the home before you sold your existing home, so that you can secure the home.
Mortgage loans over $417,000 are called jumbo or non-conforming home loans. Generally, the interest rates for jumbo loans is 0.5% higher than for conventional loans. Some lenders have stricter qualification guidelines for jumbo home loans than for conventional loans as well. Should you need a home loan that is higher than the conforming loan limit, you will want to check with your mortgage advisor to see if a jumbo home loan is the best option. When the prime rate is low, a conforming loan combined with a home equity line of credit, HELOC, may actually be a cheaper and more flexible mortgage loan option for you.
Many different factors can increase or decrease the cost to borrow money, such as annual percentage rate, or APR, loan origination costs, and private mortgage insurance, or PMI. Let's explain each briefly.
The annual percentage rate, or APR, that you hear so much about allows you to make true comparisons of the actual costs of loans. The APR is the average annual finance charge, which includes fees and other loan costs, divided by the amount borrowed. It is expressed as an annual percentage rate, hence its name. The APR will be slightly higher than the interest rate the lender is charging because it includes all or most of the other fees that the loan carries with it, such as the origination fee, points, PMI premiums, etc.
Origination fees, or costs, are paid to lenders when a borrower takes out a loan. Origination fees can vary from 0.5% or half a point to 2%, 2 points, of the loan amount, depending on whether the loan was originated in the prime or the subprime market. For instance, an origination fee of 2% charged on a $200,000 loan would total $4,000.
Private mortgage insurance, or PMI, is insurance that pays the lender in the event that you can't. In other words, if you default on the loan, PMI is protection for the lender who is taking a greater risk with a borrower who has less equity. PMI can help you get into the home you want by enabling you to pay less than the typical 20% down payment. This is particularly helpful for younger buyers who don't have the years to save but want to enjoy the benefits of home ownership. Lenders have discovered that there is a definite correlation between the amount of money a borrower puts into the home and the rate of default on loans. The more money put down by the borrower, the lower the rate of default. Generally, if you put down more than 20% when buying a home, you won't have to pay PMI.
In the last slide, we mentioned that if you purchase your home with less than 20% down, chances are you will have to pay for private mortgage insurance, or PMI. As your home appreciates or your loan balance decreases, or a combination of the two, and your equity in the home exceeds 20%, you may petition the mortgage holder to drop the PMI. This process may be cumbersome or difficult.
One way to avoid paying PMI altogether is to purchase a home with a combination first and second mortgage. The first mortgage would be limited to 80% of the home's appraised value, while the second mortgage, which would close in conjunction with the first, then provides for the balance. In other words, if you have a 10% down payment available, your first loan would provide for the 80% mortgage with a second mortgage of 10%. This is commonly referred to as an 80-10-10 transaction.
Another way to avoid paying for PMI is to find a lender that offers self-insured programs. This type of loan has a higher interest rate in place of the PMI premium. While mortgage insurance premium payments are not tax deductible, the interest associated with a self-insured mortgage is fully tax deductible. Whether you decide to get a loan with PMI or use one of the aforementioned two options depends on the aforementioned option's cost, availability, and tax benefits.
If you need to finance a large expense, you can borrow against the equity in your home. There are two ways to do this: a home equity loan or a home equity line of credit, or HELOC.
With its fixed payment schedule, low fixed interest rate, and potential tax advantages, a home equity loan is a flexible mortgage option that can help you get the cash you need from your current home. Because the loan is secured by your home, the interest rate is generally much lower than it is for unsecured debt, like credit cards. There are many kinds of home equity loans, but the most common is a 30-year amortization with a 15-year balloon, although the 20-year fixed is almost as common. You need to refinance, sell, or pay the loan off prior to the end of 15 years, lest the lender call the note. Cashing out home equity with a home equity loan involves receiving cash for the entire loan amount and repaying it by making fixed monthly payments until the debt is retired. This makes the loan ideal for situations in which the entire amount will be needed at once, like debt consolidation, financing the down payment on a rental property, or for rehab or repairs.
Another way to use home equity is through the home equity line of credit, or HELOC. A HELOC is a variable rate interest loan, usually prime plus a margin, and there is often an interest-only period. It is a line of credit, and so long as you stay within your credit limit, the initial underwriting covers it. The borrower is granted a line of credit and can draw funds and repay them again and again. This is called revolving credit and is similar to most credit card accounts. These loans are ideal for recurrent expenses like closing costs and down payments on investment properties, or uncertain expenses like a long-term remodeling project or emergency funds to cover holding costs.
Before converting unsecured debt to debt collateralized by your home, be very sure that you can make your payments. While a credit card company can't do much if you default, your mortgage lender can foreclose and take your house if you can't pay. Also, homeowners should consider the implications of trading home equity for cash before taking a second mortgage. The lack of an equity cushion could make it difficult to sell the home should it become necessary. In addition, studies show that many homeowners who use their home equity to consolidate debt promptly run up their credit cards again, leaving them with no equity and more debt than before. However, homeowners who use their equity wisely and keep a lid on expensive, unsecured debt can build wealth from the equity in a property and enhance their financial wealth.
There are 3 government agencies that insure mortgages: the Federal Housing Administration, or FHA, which is part of HUD, the Veterans Administration, or VA, and the Rural Housing Service, or RHS, which is a branch of the U.S. Department of Agriculture. These government loan programs insure but do not fund loans offered by lenders. Government housing loan programs help lower the cost of mortgages so that more people can afford to own their own home. Only approved lenders can offer these loans, and the property to be purchased has to meet certain standards in order to qualify. These programs vary from year to year and in some cases from month to month. Now, let's talk about the FHA.
The FHA offers a mortgage financing program that insures home loans and was established in 1934 to help stabilize the real estate market and help families achieve home ownership. The FHA doesn't make the loans itself. Rather, it serves as an insurance policy for lenders. Because FHA financial loans requirements are more relaxed than traditional commercial loans, more people are able to afford to buy homes. Home buyers who wish to take advantage of falling house prices but face credit issues, have little cash for a down payment, or are limited by their income may be able to finance their home with an FHA loan. FHA insurance makes lenders more willing to work with someone who might not completely fit their usual loan qualification requirements. The maximum amount for an FHA loan is determined by the county in which the property is located. Visit the FHA webpage to find the limit for your area.
The FHA offers many loans or grants. The location of the project and current economic situation of the area dictates what is available. These can include the following, which are shown on the screen.
The chief advantages of an FHA loan include more generous income guidelines, higher loan-to-value (LTV) limits, meaning that borrowers can refinance up to 98% of their home's value, lower debt-to-income ratios, lower down payments of 5% or less, streamlined refinancing, and less stringent credit requirements. The FHA also finances purchases of fixer-upper homes. In other words, with these homes, the mortgage is based on what the property will be worth on completion of repairs or rehabilitation.
FHA financing does carry a few disadvantages, however. The mortgage insurance premium paid on an FHA loan is always significantly higher than on a conventional program. For FHA loans, the borrower will be charged a mortgage insurance premium equal to 1.5% of the purchase price of the property and a renewal premium of 0.5%. By contrast, the mortgage insurance premium charged at closing on a conventional program is as low as 0.5%, with renewal rates as low as 0.3% in subsequent years.
If you live in a rural area or small town, you may qualify for a low-interest loan through the Rural Housing Service, which offers both guaranteed loans through approved lenders and direct loans that are government-funded. These loans enable low-income families to get loans for homes.
Reverse mortgages are offered by state and local governments as well as banks and mortgage lenders. Reverse mortgages pay you money as long as you live in your home. These loans are designed for people age 62 and older who own their homes and need cash. The loan is made against the equity in the home and isn't paid off until you sell or move out of your home. Until that time, the borrower receives regular payments prescribed by the terms of the loan. Shop carefully for these loans because interest rates and fees tend to be higher than in traditional mortgages.
Ever since GIs returned from World War II, the United States has had a tradition of giving military veterans a leg up in establishing themselves in civilian society. This tradition continues with the VA loan program, which is designed to help veterans and military service members obtain mortgages with better terms than conventional routes.
All veterans who are in the service or have served and were released with an honorable discharge are eligible. For more details on wartime and peacetime service eligibility periods, as well as the procedure for veterans who have not been honorably discharged, please see the guide that accompanies this lesson.
The VA loan program guarantees a portion of a mortgage made to a qualified veteran or service member. As with FHA loans, the VA itself does not make the loan, but they guarantee a portion of the loan. The VA allows lenders, including banks, savings and loan associations, and mortgage companies, to offer the following: credit to borrowers who otherwise might not qualify, interest rates which may be lower than for non-guaranteed loans, and mortgages with little or no money down.
VA loans are better than conventional or FHA loans in some ways, so veterans should look at the pros and cons of each program before choosing. Some advantages of VA financing include no down payment required. Buyers can finance 100% of their purchase, including the 2.2% funding fee. Super maximum loans on homes worth up to $1 million. Less restrictive underwriting guidelines. Streamlined refinancing. No monthly mortgage insurance. Limited closing costs. And, best of all perhaps, VA loans are all assumable, which can make it easier to sell a home. VA loans can also be used to build a home, improve a home, or buy a manufactured home and lot. The VA can also provide assistance to borrowers with temporary financial problems and/or who are in danger of foreclosure.
Most of the disadvantages of VA financing don't apply to many borrowers. However, veterans considering VA and other options should be aware of potential pitfalls in financing with the VA mortgage. Some of the potential disadvantages are that VA loans that need no down payment are limited to $417,000, and the VA upfront funding fee is 2.2%, which covers the mortgage insurance for the life of the loan. This could prove expensive if the borrower doesn't keep the home for at least a few years. Also, with VA loans, refinances are limited to 90% of the home's value, even if the refinance is a streamline from one VA loan to another.
Unlike VA loans, which are guaranteed by the VA and are only granted to U.S. veterans and their spouses, VA Vendy financing is available to veterans and non-veterans as well as owner-occupants and investors to buy VA home foreclosures. Under this program, the VA sells Vendy financing loans to national lenders. VA Vendy financing is not available on all VA repossessed homes. However, so check the VA home list for the availability of VA Vendy financing on a particular VA home foreclosure. There is no limit on the number of VA foreclosure homes you can buy with VA Vendy financing, but you can only have 5 active loans within a 6-month period. The interest rate is set by the VA.
Another government program are the Community Homebuyer Programs, which are designed to assist communities in redeveloping residential areas and in providing reasonably priced homes for those with limited income, credit, or down payment. Many mortgage lenders offer products in conjunction with various community initiatives to increase home ownership. Typically, future homeowners are required to attend a course that covers the basics of home ownership. That includes topics like how mortgage loans work, organizing finances and establishing a household budget, making responsible financial decisions, etc. These programs may also offer low-interest loans, down payment matching, or down payment assistance. Some loans require as little as 1% down or feature a mortgage tax credit certificate program, which reduces the federal income taxes of qualified borrowers.
Mortgages made by banks and other lenders are typically sold on the secondary market in order to produce cash so the lenders can make more mortgages. The more mortgages a lender makes, the more money it makes because most of its income comes from fees, points, and other charges associated with the loan origination. The largest purchasers of mortgages on the secondary market are the government-sponsored enterprises, or GSEs, the Federal National Mortgage Association, commonly known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, or Freddie Mac. These large enterprises were created by congressional charters in order to make mortgages available to more people with low and moderate incomes. They became private companies, but recently came again under federal oversight.
Not surprisingly, there are legal issues involved with getting a home loan. Often, borrowers go in to sign mortgage loan documents and find their mortgage loan is not the one they negotiated. Suddenly, there are origination fees, prepayment penalties, higher interest rates, or loan payment terms different than what had been discussed. In order to prevent surprises in your home loan and to compare lenders and mortgage products, always ask your lender for 2 key documents: the Mortgage Loan Disclosure Statement, or MLDS, and the Truth in Lending Disclosure Statement, or TILD.
Truth in lending laws were passed by Congress in 1969 as part of the Consumer Credit Protection Act and ensure that consumers make informed decisions regarding extensions of credit. While creditors are required to disclose certain information, it's still the consumer's responsibility to research creditors and credit terms. These laws require anyone who extends credit to a consumer to disclose the following: how finance charges were computed, annual percentage rate, total finance charge over the life of the loan, payment schedule and total number of payments that will be made over the life of the loan, prepayment penalties, if any, late payment terms. For ARMs, the lender must disclose the maximum interest rate that can be charged and when and how finance charges are imposed. These items must be disclosed upfront, in writing, and in terms that are easy to understand. In addition, the real estate section of the Truth in Lending Act gives consumers something called a right of rescission, on refinancing and line of credit transactions. This means that you have 3 business days from the date you signed the agreement to back out of a loan. No questions asked. And the lender cannot charge you any kind of cancellation fee.
Adopted in 1974, the Real Estate Settlement Procedures Act, or RESPA, is another consumer protection law. It covers purchase loans, assumptions, refinance loans, property improvement loans, and equity lines of credit for 1 to 4 unit residential properties. RESPA serves 2 functions. It requires certain disclosures to borrowers, and it prohibits certain practices that can drive up the closing costs of a loan. If the loan servicing is transferred, RESPA also provides further consumer protection by prohibiting kickbacks, fee splitting, and unearned fees in return for referrals for settlement services. RESPA also prohibits the seller from requiring the use of a certain title insurance company, and it places limits on escrow accounts.
Your lender is required by the RESPA to provide you with a good faith estimate, or GFE, for closing fees within 3 days of applying for a loan. The GFE contains closing fees, also called settlement costs, that cover almost every expense associated with your home loan. Because closing costs typically amount to between 3% and 5% of the sale price, it is best to wait until you receive the GFE before committing to a loan. Smart loan shoppers obtain GFEs from 2 or more lenders, compare their costs, and ask questions about any large discrepancies. Shown on the screen are a list of some of the fees you'll find on your GFE. Please take a moment to review them before proceeding to the next slide.
Many additional federal housing acts have been passed over the years, helping to guarantee fairness and openness to the home buying and development process. To see a complete list of these acts and brief descriptions of each, please review the guide that accompanies this lesson.
Refinancing is simply taking out a new mortgage. If you are considering refinancing your loan, you first need to determine your short and long-term goals and then evaluate the refinance options available. Here then are a few reasons you might refinance an investment property or even your own personal residence. By refinancing your mortgage, you can lower your interest rate and, as a result, your monthly payment. By refinancing, you can capitalize your equity just like your checking account. Refinancing can be a great way to get cash out of your house and into your pocket. Having multiple loans is often a burden. Refinancing allows you to consolidate your loans and pay your debt with one easy payment at a lower interest rate. If your credit score has recently improved, you may be eligible for a lower interest rate on your mortgage. Refinancing can help you lower your rate. And finally, if you are in an arm that is about to adjust upwards, refinancing can stop the rising payments and lock in your monthly rate and payment and get peace of mind.
Here are some loan options to consider when you refinance. Property owners who need cash now may want to negotiate a cash-out refinancing loan from mortgage lenders. Unlike a home equity loan, which involves adding an additional loan to your existing mortgage, the cash-out refinancing loan pays off the original home loan and then some. With a cash-out refinancing loan, they'll get cash from the transaction, but will have to pay up to several $1,000s in closing costs. This transaction can be worth it if the drop in rate from the original loan to the new loan is significant. But it may be wise to examine other options, including a home equity loan, which also delivers cash out, but which leaves the original loan in place. For example, a homeowner with a $120,000 balance against an initial $225,000 mortgage may be able to obtain a $165,000 cash-out refinancing loan. From the new loan, the homeowner can apply $120,000 to retire the original mortgage, and then pocket $45,000 for personal use. To do so, the borrower has traded $120,000 of debt remaining in the old loan for $165,000 of debt in a newer, lower interest rate loan. If you currently have a high fixed rate mortgage and the rates have dropped due to market conditions, then you may want to refinance to a low fixed rate loan. Also, if you have an ARM, you might consider this option in order to get the security of a fixed rate. Even if your adjustable rate is low now, it is not guaranteed to remain that way. This option is a good choice if you are not planning on moving within the next 5 years. If you need to build up equity quickly and pay off your mortgage sooner, then refinancing to a shorter-term loan is your best choice. A lot of times, if you refinance to this type of loan, your monthly payments will be higher, but you will pay substantially less interest and your mortgage will be paid off sooner. Also, you would benefit from a larger tax deduction on interest if you move from a 30-year fixed to a 15-year fixed loan. There may be some cases where you can refinance to a shorter-term loan without raising your monthly payment. For instance, if you've had your current mortgage for enough years. If your current monthly payments are higher than is comfortable for your financial situation, then you may want to refinance to a longer-term loan. This will decrease in your monthly payments because you now have more time to repay the loan. Any loan where the lender pays all of your closing costs, title and escrow fees, appraisal, lender's fees, etc., is called a no-cost loan. With a no-cost loan, you can refinance for any incremental drop in your interest rate since the transaction costs are zero. Even in a declining rate market, a no-cost loan makes sense. Should rates continue to decrease, you will have invested nothing in the loan costs and can simply refinance at any time. Some borrowers refinance every year or less. No-cost loans will always carry a slightly higher rate than a loan that does not pay your costs. A no-cost loan is the better strategy if you plan to keep your loan only for the next 2.5 to 3 years.
As you may recall, a jumbo loan is a mortgage with a total that exceeds conforming loan limits. Homeowners sometimes refinance to jumbo loans to boost buying power or retire mortgages that no longer suit their goals. The relatively high risk of defaults associated with jumbo loan refinancing means that lenders will probably charge higher interest rates. Closing costs for jumbo loan refinancing packages also can be comparatively high. Speak with a variety of lenders to find whether a jumbo loan is right for you, or if you'd benefit from a more conventional second mortgage in combination with other options, including debt consolidation.
Lenders require a lot of paperwork to assist them in evaluating your loan. In short, lenders will want to verify who you are, your current and recent income, your assets, and your liabilities. Depending on the lender, this can mean a little or a lot of paperwork. For more detail on some of the documents lenders require for all of the aforementioned areas, please review the guide that accompanies this lesson.
Lenders calculate debt-to-income ratios to help them limit risk. After your credit report, these ratios are the most important factor an underwriter looks at when deciding to lend. If a borrower does not meet a lender's ratio, they will be denied the loan. Traditionally, most lenders require that borrowers have a debt-to-income ratio of 28:36. This means that no more than 28% of your total monthly income from all sources and before taxes can go toward housing, and no more than 36% of your monthly income can go toward your total monthly debt, including your mortgage payment. The debt they consider for the second number includes longer-term loans like car loans, student loans, credit cards, etc. These ratios are also referred to as front and back mortgage ratios. Front to describe the first ration and back or second to describe the second ratio, and can be expressed numerically as 28/36. Progressive lenders sometimes embrace higher ratios depending on what is taking place in the economy. As a result, You may find ratios up to 40-49 being offered for well-qualified borrowers. Shown on the screen are typical debt-to-income ratios for the main loan types: conventional, FHA, and VA. Take a moment to review them before continuing to the next slide.
For now, we leave you with some action items, tasks you should be able to perform before the next lesson. So please complete these before moving ahead. Review the traditional loan application process and determine if this is a financing option for you or for your investment properties. If it is not, is it an option for you to refinance your existing home or for you to acquire your own home? Pull and review your Tri-Merge credit score and rectify any errors that you might find on it with the credit bureau. Go back to your lenders list created in the financing lesson and revisit these lenders to find out what loan options might currently be available to you on your investment properties. Find at least 10 motivated sellers. Narrow down to 5 properties of interest and submit offers contingent on securing a loan. And finally, if you find a loan program you like and think you will qualify for, prepare and submit all the appropriate documents to your lender for a pre-approval.